Good morning, everybody, and welcome to our very first webinar for 2019. In this webinar, we're looking at practical issues when implementing IFRS 16. Today, I'm joined by Kevin Frobus, who's an Associate Director in our IFRS advisory team, and Kevin is based in Sydney. So welcome to the webinar, Kevin. I hope all of you have had a good break and that you're refreshed for the new year because this is going to be a big year. Now, Kevin has actually decided that 2019 is the year of lease accounting. And I have to agree with him. In 2018, we spent a lot of time with our clients on the new IFRS 15 and IFRS 9. But this year, IFRS 16 is really the flavor of the month. And therefore, we thought we'll kick off this year with a webinar on lease accounting. Now, as you know, we've spent a lot of time as well, doing training and having discussions with our clients on lease accounting IFRS 16 over the last year or two. But this year, there's definitely a urgency around it. We have to step it up. Now, the effective date of IFRS 16 is for years beginning on or after 1 January 2019. Therefore, if you've got a 31 December year end, you are already within your first year of applying IFRS 16, and 1 January was your date of initial application. So most of our clients in Australia have a 30 June year end, and therefore for them, they've got 5 months to go to the date of initial application or the date of transition. So this really is an important topic. We have to get ready, be ready, and as you know, IFRS 16 has a big potential impact if you've got a lot of leases, especially if they're longer term leases. So what is the big change? Now, the big change is really a change for lessees. There are some smaller, more minor changes for lessors, but it's a big change for lessees. And in particular, lessees will in future account for all leases the same way. Therefore, in the past, you had a distinction between finance and operating leases. Going forward, all leases will be treated the same way, and that way would be similar to the way we've accounted for finance leases in the past, which means you will have a right of use asset in your balance sheet. You have a lease liability in your balance sheet. That right of use asset will be depreciated. You will repay your lease liability and there will be interest expenses. And we've talked about that over the last year or two. I think if we really look at the impact, finance people would say, after we've done all the debits and the credits and the calculations, what's the impact on our financial statements? And this is quite let's call it a personalized approach because every entity will have a slightly different impact. But we know a few common impacts, and that is there's an impact on profit volatility. It's no longer an even operating lease expense. There will be a higher interest expense at the start of new leases and a lower interest expense towards the end. We know there's an impact on net current assets because we now have no additional current assets, but we have additional current liabilities around the lease payments that will be made within the next 12 months. We know there's a positive impact on EBITDA because EBITDA will now increase. It's before depreciation, it's before interest expense. We know on a very practical level that a lot of entities who have bank covenants and who have bank covenants potentially linked to net current assets will have to renegotiate or start renegotiations of these bank covenants and be aware of the impact of IFRS 16 on their bank covenants. We also know that for a number of entities, the new IFRS 16 could have an impact on the declaration of dividends. Two reasons. It could be because there's an adjustment to retained earnings on the date of initial application, or it could have an impact on their ongoing profit and reduce ongoing profit due to the increased interest expense. So you have to consider the impact on your declaration of dividends. We also know there's an impact on interest rate covers because there's a lot more interest expense, and also debt equity ratio. There's an increase in your debt and no increase in equity. And really what we wanted to say here is, although these are like common impacts that we've identified over a number of our clients, I think it's very important at the start of 2019 that each organization, and that's the finance team, the boards, sit back and say, what are our organization's key ratios and key performance indicators? And how will IFRS 16 impact our key ratios and our key KPIs? So the question is, what are your key ratios? What are your KPIs? And have you assessed the impact of those? So I think a lot of our webinars over the last 2 years focused on the technical requirements of IFRS 16 as we were trying to educate and assist our clients and especially finance teams, CFOs, about technical requirements around IFRS 16. However, when we start to speak to CEOs, to audit committees, to boards, to directors, we've realized the following, that IFRS 16 is one of those standards that although it has all these technical issues, complications, it actually creates or leads to a business problem, a very real business problem. It's not just an accounting standard problem. And there's great interest in IFRS 16 for this reason. And what we've done is we've tried to put it schematically or in a diagram to try and explain as a result of the discussions we've had. And we've got two diagrams. There's a diagram for private sector entities and there's a diagram for public sector or not-for-profits. And really this diagram for private sector entities, the issue or the business problem is to preserve shareholder value. So what boards and entities and directors are worried about is how do we preserve shareholder value? And we know there's this new standard, and we know the standard has an impact on the financial statements, and we've looked at KPIs and we've looked at key indicators, but there's a potential significant downside of IFRS 16 non-compliance. So if you're a listed entity and you're not complying with IFRS 16, or you comply with IFRS 16 and all the numbers flow through your financials, it could have an impact on your share price. It could have an impact on your ability to declare dividends. If you're not complying with IFRS 16, you've got continuous disclosure obligations. If you're a private entity, banking covenants, dividends again, and if you look at governments, really the big issue there is around accountability for the judicious use of public funds. But all of those flow into profit and liability reporting. The negative impact that IFRS 16 would potentially have on your profit and the negative impact that IFRS 16 will have on your liabilities and the increase in liabilities. Now, at BDO, in speaking with clients, we've come up with a process to address this issue that's highlighted in red. And you really have to start right on the right-hand side, and it's a whole a process. And we believe it should be addressed through a project management approach or a project management solution. And if you look at that project management approach, you have to start with your lease data. Then you look at assessing all that data. And then you need a technology solution potentially. And I've put in there BDO lead because that's our BDO technology solution. And Kevin will expand on that. And then you also, very importantly, need IFRS advice, because the decisions you make, the judgments you make, the transition approaches you make, all, there are alternatives, there are practical expedients, but you need IFRS advice to make the best possible decision for your organization and the needs of your organization. So it's a whole process, project management. If we go on and we look at, sorry, I've gone too fast. Go up. If we look at public sector, not-for-profit entities, the big issue is around maintaining public support. It's a very similar diagram, but the key thing is if we put out budgets and forecast as a public sector entity, if we get money allocated to us for a period of time, can we explain, are those budgets accurate? Are those forecasts accurate? And can we explain how we've actually applied the money? And IFRS 16 again creates some issues there. I would like to also flag that there's great interest in the impact of IFRS 16 on organizations. Now, this is just one article that appeared in the Financial Review last year. And this one was looking specifically at Meyer and Woolworths and how the new lease accounting standard would impact them. So, this was in the Fin Review. They're talking about it. And they're saying, there's a big impact on them. Even as early as July 2017, there was a similar article in the Fin Review that I've included the link to, talking about the impact. So I think it's really important that we understand that that IFRS 16, people are interested in it. People want to know about it. People want to know what the impact is. It's one of those standards that's really creating a bit of a buzz. So out of that, and if you look at the newspaper articles and conversations, I think it's very important to say, how is your organization determining and calculating the impact of IFRS 16? Because people want to know. And maybe just note that a lot of these organizations have disclosed and have in the media what the impact will be, but they have not adopted those standards yet. They haven't early adopted these standards. IFRS 16 is not popular that way. People don't seem to early adopt, but they are slowly communicating what the impact is. But in order to communicate the impact, you first have to determine the impact, and then how is your organization communicating the impact of IFRS 16 to its stakeholders? So it's really important that everybody involved, whether it's audit committees, whether it's directors, whether it's suppliers, creditors, and users, understand what the impact will be. So for the next section, we want to look at what are the biggest problems when implementing IFRS 16, and we're basing this on our experience over the last 12 months. Now, for this section, I'm going to hand over to Kevin, who's worked on a number of these clients with me, and he'll step through this.
Thank you, Aletta, and good morning, everybody. And yes, Aletta, it really is the year of the lease. The biggest problems with implementing IFRS, I think you've outlined them very clearly. There are a couple of key underlying assumptions or underlying important factors that you've already put on the table, and those are what are the key ratios and impact, which very often happens at the board level or at the senior level. You've outlined technical issues and complications, which really is the accounting standard and its nuances. And then you've outlined that this is a project management issue. In the work we've done, most of our clients who have actually attempted to adopt this have followed those approaches, whether they've come from advice from us, but it's a natural progression that you essentially establish a project team at the beginning. Most clients have done that, and most of them would put, for example, a finance person, maybe a property management lease person, or even an IT person on that project team. Some of the issues you're going to face when you are preparing for transition is that the skills and expertise on this project team that are missing are really important, an IFRS person. And also, and this is really important, somebody from the board or somebody who actually can make decisions that ultimately affect the organization. And this is really key. An issue that's faced by a lot of organizations is they treat this as a finance project or they treat this as a compliance project. And so then what happens is when the number starts to be determined and the number starts to be reported up through the organization and communicated through the organization, there's often a gasp at the higher level because the number is much bigger than anticipated. And at that point, it's almost too late because decisions have been made which have taken various options and choices in the implementation. You kind of can't go back. So one of the issues you're going to face at the start of your project is who's on your project team. And like I said, the composition really should be made up of an IT person, a finance person, a lease management person, but don't forget to include somebody that has IFRS knowledge. And that doesn't necessarily have to be an external IFRS person. It can be internal, but most organizations are reaching outside for that because the nuances of the new standard aren't necessarily available in-house. But very importantly, the involvement of a decision maker. And that is somebody at a board or an audit committee level who's able to guide the team with the decisions they make that are aligned to the business's strategy. I've put auditor involvement there. This is an iffy one a little bit. The auditor involvement is really just to keep them in the loop. You don't want the auditor to come at the end and upset the cart. So that's probably just a reporting function to auditor to make sure they are there. Now, I will regale one example to you of how this composition hurt one of a listed client I know. The listed client, the board had made a decision and disclosed it in a previous financial report that they would be adopting the modified transition method. Now, later we'll talk about the transition methods later on, but the modified transition method is one of the ways you can transition to the new standard. When the number arrived at the board, it was so big and it had such a big impact on subsequent financial accounting. They literally took it out of the financials, and in a later year, they disclosed that they'd revised their decision about the transition method that they had adopted. And that tells me that the project team was not constituted with board involvement at the start, which means that they had to go back and start again. So that's very important. The issue you're going to face at the start is who's on your project team. Moving on to it is, this is probably more an error that is made at the project team level and perhaps at the board level as well. Most project teams or organizations that have started this that we've been involved in make three key assumptions at the beginning. And that's why I've called them embedded assumptions. They're almost embedded in everybody's mind without discussion. One is we have all the data. It's going to be easy. The second one is we must have a technology solution. It will solve all our problems. And the third one is we're going to take the easiest option possible, especially when it comes to transition. Those assumptions should be challenged right at the start of your process. Because one is, do you have all the data? Now, having the data means, and this goes back to Alette's diagram before, there were four steps in the diagram: data, data assessment, technology solution, and so forth. So the completeness assumption on this is really important. One of a public sector organizations or department that we worked in had almost 1,000 motor vehicle leases, of which they had the data for only 6 of them. Now, that is an extreme example, but they spent 3 months arriving at the concept that they only had 6 lease documents for almost 1,000 motor vehicle leases. It wasn't that it wasn't available in the organization. Just wasn't available in the finance function. So they actually had to go out and find it elsewhere. It is an extreme example, but it's something that you really have to check before you get going. But more importantly with the data is, and going back to Alette's diagram earlier, having access to client data and having data assessment, the next thing is, what do you do with that? And this is where it's really important that your board level or audit committee level decision maker is actually involved. Because once you have the data, you have to start making accounting policy choices, and you have to start making decisions about which avenue in the standard are you going to choose. There are an enormous number of practical expedient and policy choices in the standard, and each of them have a different outcome, not only on the transition number, but also on an ongoing basis into the future. Projecting 2, 5, or 10 years into the future can really be important, and the numbers can actually hurt the business strategy of the organization and those KPIs that Aletta was talking about at the beginning. So making assumptions must have decision makers, but you also need to actually just have, and this is where the IFRS skill comes in, having somebody who can at least explain the outcome of the various options available. So before you even start to put numbers to it and to model it, at least understand what the implications of the various options are. So make sure you have the understanding of somebody who understands the nuances of the standards. And I put that on there about the judgments and the optional allowances. Remembering once you've chosen a path, very often that becomes a policy choice, which means you can only change it again as a change in accounting policy. So you don't really want to get into that. All right, so that's the data assumptions, even before you've moved on to things like technology solutions and so forth. Now, the technology solution the practical issue is virtually every project team that I have been involved in assumes right at the start that they must buy a software solution, and that if they buy the software solution, it must tick all the boxes and solve all the problems. Please remember in your project team and in your management of this project that the IFRS software really just is one component. And there really are two extremes emerging. On the one hand is the most complicated IFRS software that can produce wonderful reports that integrates with existing property management softwares and financial reporting systems. And on the other hand is Excel. Those are the two options that everybody thinks is available. But really those aren't the only options available, and they aren't the only strategies that must be considered, because most organizations are treating IFRS 16 as a software or an IT problem, and they're starting to put complicated IT strategies together with configuration outcomes and design and implementation strategies. You might end up there, but you don't have to. So make sure you challenge yourself on that embedded assumption before you start to buy software and to bring software developers in right from the outset. The other thing is, before you move on to things like software solutions, and before you move on to things like what's the impact of the numbers, perhaps it's more important that the project team stand back and actually says, look, what do we actually need? What are we trying to produce in terms of reports? How are we going to upload our data? And many organizations we are talking to very late in their project management piece are starting to realize that the only thing they really need is a monthly report and the journal entries, which account for the leases. So that might be the basic need. It can get more complicated for there, but understand what the organization needs from the standard to actually embed it in their processes before you start to go on to data assessment and running the numbers and making decisions on software purchases. But I'd like to come back to something then that Aletta said earlier on, and that is determining the impact of IFRS 16. Everything in your project team should actually start with this question. Before you make decisions on the ongoing software solution and who's got to be involved and how you're going to do this and which reports you need, really you need to say to yourself, what is the impact of this standard? And this is going to align what Aletta said at the beginning, which is, what are my KPIs? And what are my ongoing needs? Now, there are two angles to this. There's determining and calculating the impact of IFRS 16 at the date of transition, and then there's the impact on an ongoing basis. And you need to understand the implications of that. There's various transition methods. So of course, that can actually have an impact on where you go. And starting to emerge in the industry is actually that modeling the impact of the transition methods at transition and on a budgeted ongoing basis is probably the first step under any scenario. I'd like to hand back to Aletta at this point because we've worked on a number of these, but Aletta has probably had more experience in the impact at the start and probably has got a couple more bruises than I have on this one. So Aletta, back to you.
Thank you very much, Kevin. I suppose what we're looking at here is when we speak to clients, we used to start the conversation, have you decided on a transition method or a transition approach? And you would remember last year we did a whole webinar on the 3 different approaches and the benefits and the disadvantages and how you do the calculations. And then often when we speak to people, a lot of people have said, listen, yes, we've decided the easiest one. We're going to do, modified retrospective, and the one where your lease liability just equate to your right of use asset. End of story. And then we say, okay, but have you considered the other alternatives? Have you considered the numbers, the impact of your selected approach at the date of transition 1 July 2019? But also, have you considered the impact going forward, let's say for the next 10 years? So actually, for a number of our clients, we ended up doing an impact assessment on 1 July 2019, their date of transition. And as we've explained, the modified retrospective approach where the lease liability equate the right of use asset, obviously on 1 July 2019 have no impact on retained earnings, and therefore, a lot of people really like that approach. However, when we started to also include the impact over the next 10 years, they could see, oh, what's really happening here is all these expenses have been pushed to the future, and I don't like what it's doing to my profit over the next 10 years. And then opened up the conversation. There are 3 transition approaches, if you look at them carefully. Let's run the numbers at the date of transition and on an ongoing basis for all 3 approaches, actual numbers. So what will it do to profit for 10 years? And what will it do on the date of transition? What will the numbers be? Let's take that to the audit committee or the board, and with full information in front of them, let them decide on the appropriate transition method. And I think that is really, really important. You can conceptually think, this is what I want to do, or you can say I don't have data, or you can say this is, the quick and dirty. But in the end, the directors want to communicate, and they want to preserve shareholder value. Therefore, they're not driven by the effort. They are driven by the shareholder value and retaining shareholder value. So that was a really big lesson that we've learned, and a number of our clients learned. And these days, we really don't actually enter into this conversation without doing a proper analysis of the numbers under the 3 alternatives. I suppose the other thing that's happened for private sector entities, but mainly for our public sector entities, is that we've realized that entities, when we do all these calculations at the date of transition and, the impact on an ongoing basis, obviously those calculations are done based on existing leases. And often they look at these projections over the next 10 years and they say, hang on, something's off here. We know we are growing. We know we're expanding. Or public sector, we know we've got a certain level of staff and we'll always have that level of staff. Why is the depreciation and interest expense and the impact on profit and loss, suddenly so low in years 6, 7, 8, 9, 10? And then when we looked at the numbers, it's because existing leases was really just negotiated for the next 5 years. And therefore we realized, hang on, to really consider the impact and to communicate the impact. I know the accounting standard wants you to account for existing leases, but for budgeting and for forecasting and for planning purposes, for business problem solving, you need to look at proxy leases as well. And I think that was an important lesson, because we want to make sure that public sector entities put in the right budgeted numbers and the right forecast numbers to get the right amount of money or appropriations out of government. So that was another very important thing. So we've got a lot of clients doing all these calculations on existing leases and then repeating all these calculations on existing plus proxy leases, and based on that decide what they want to do. So I think that's important. It comes back to stakeholder involvement and the board and the audit committee. It's really important to explain the impact, which we've done theoretically over years, but now the numbers, do the number crunching. I think I'm yet to meet the board or audit committee who's not completely surprised by the sheer size of the adjustment. A lot of people are saying full retrospective method is time consuming. You need a lot of data, but it gives you the best comparable information. And there's another thing, it does keep a lot of the expenses where they belong in the past. It impacts retained earnings on the date of transition. So if your retained earnings can stomach that hit, that is maybe a good way, because it protects your future profits. If you look at the two modified retrospective approaches, from a process perspective, simpler, more practical experience, less data that you need. However, it's really shifting your expense to the future. So if you are really looking at achieving your goals, continuing to declare dividends, meeting targets, looking at bank covenants, showing growth, and it's all about the future and the past is the past, then maybe these methods are not the best method. So there's a lot of considerations to take into account that's over and above just doing calculations. So if we look at the approaches, and we've done a whole webinar on this, there's the full retrospective approach and there's the modified retrospective approach. But I just want to flag again that within the modified retrospective approach, we've branded them approach 1 and approach 2. Approach 1 is the one that most people go for, because the right of use asset equal the lease liability less the accrual or the prepayment that exists under the old AASB 117. Where with modified retrospective approach, you have to do a lot of calculations. You also need more data, and you also get an impact on retained earnings. So I suppose don't think there's only two approaches. There's 3 approaches. They all have the peculiar pros and cons, and important to do an assessment around all of them before you make a final decision. I think what I thought I'll do next is Kevin and I and our IFRS advisory team, which is growing by the day, it feels like, have worked with clients over the last year to actually get ready for IFRS 16. And we've learned a number of lessons from implementing, and we've worked with project teams and we've learned from them. And also it's led to us evolving how we assist our clients, because we want to tailor what we do to the needs of our clients, and we want the best outcomes for our clients, and we want to, we don't want to just do calculations. We want to say, listen, what are you looking for? How can we assist you? How can we get the best outcome? And therefore we've evolved our service offering. So at the moment, our service offering around IFRS 16, broadly, we've got 4 types of offerings. Now, the first one I've talked about before, and you can read a lot about it on our website, and that is BDO Lead, our fancy technology solution for those clients who have hundreds or thousands of leases, and quite an amazing tool that was originally developed in BDO in Germany, and we've already implemented that and a number of clients within Australia. We have, however, number two, come up with a BDO lease management service solution, which at the moment is actually our primary solution that we offer our clients, because we found that this is what clients are looking for. They keep themselves busy with the business problems and the challenges at a business level, and they say, BDO, you do the calculation for us, you manage it for us, you keep the data for us, you run the reports, you give us the journals every month, and we'll focus on our business. So it takes away a lot of the noise and the hassle for clients. A third alternative is where clients say, listen, at this stage, I only want to know what the transition adjustment will be. We do the work, we give them the number. Maybe in 6 months or a year's time, they'll come back and say, listen, it's a year later, what is the journal for the year? Another engagement that can happen. Part of this transition adjustment, we give them alternatives often of the three alternatives, and assist them to, guide them to the best decision and the impact on their financials. And then the last one is we still having a number of clients, and this group is particularly audit clients, where they want advice or guidance around implementing IFRS 16. Now, for audit clients, there's an independence issue around that we can't do calculations and give you journals and sell a technology solution to you for independence purposes. But we can still, if you've got another technology solution, and we know a number of them out there, help you with the IFRS aspect. Because a lot of these technology solutions only give our clients the calculation, the technology aspect, saving, storing the data. But to making the judgments, picking practical expedience, coming up with accounting policies, we can still help. So number 4 is particularly where we work with our audit clients. I've prepared some slides on each of the alternatives. If you're interested in more information, I've even included some pricing to give you an idea. When would you be interested? The clients that we've worked with, the ones who want BDO lead the full technology solution, they want control of their lease data. They want to maintain their own lease data. So their staff want to go in every day and make changes, update stuff. They've got so many leases, there's constant changes. They want to run their own reports fairly regularly. They want to run a report that gives them the journal entries, but they want control of that whole process. Now, BDO Lead is a cloud solution. It also comes with ongoing software and IFRS support, but this is an expensive option. So this is really for those entities that have a lot of leases. So there's a once-off implementation fee creating the virtual machine in the cloud, and there's also an annual license fee, which includes obviously the IT support and the IFRS support. The big benefit of this is the clients who go for this, they would like to ultimately, as a phase B, integrate BDO Lead with their accounting software, with their property lease management system. They want a customized reporting potentially. And that is a separate quote, and that's done with us and our technology partner that help us with this. The one that I said is the primary offering at the moment is BDO Lease Management Services, where we work with a client to populate an Excel spreadsheet that we provide with all the lease data. So we have everything we need. We then upload it into BDO Lead, our version. We maintain the data. The client provides changes to the data, maybe extensions, terminations, new leases on a monthly basis to us, and we prepare the reports. So every month we will get all the changes, let's say by the 20th of the month, and by the 30th of the month, we give them the journal entries for that month. And the client will tell us, I want a journal entry for the company, or I want a journal entry for each subsidiary, or I want a journal entry for each division. They tell us what they want, how many journals, and we design it that way. But we give them the journals every month, every quarter, every year, whatever they want. We also give them the actual report out of BDO Lead, which is in Excel, which supports the journal. So it's audit evidence for their auditors to say, these are the journals we've processed, and this is the audit evidence why we've done it. This is how we've calculated the depreciation, how we've calculated the interest expense. And this whole BDO lease management service, the key thing here is that this is run out of the IFRS advisory team, out of Kevin and my team. And therefore, there's IFRS involvement and oversight throughout. So if we get changes to data, we understand what has to change and we expect a certain impact, and therefore we can test all along, do a sense check whether we agree with what's produced. Now we've got clients. We've got one client that's got only 3 leases, and we're doing lease management services for them. They just don't want the hassle. We've got clients, and that's around $5,000 a year. We've got clients, anywhere between 10 and 200 leases, and this is not hard and fast lines, where we charge them 15,000 a year, and we give them the report every month. We've even got clients doing lease management services where they've got more than 200 leases, and the price really depends on the complexity of the leases, the number of the leases, and the time involved to manage the leases for them on a monthly basis. I think the other thing that's important is that part of the lease management service, we do consult with the client upfront on what are the transition options. We run the numbers on the 3 alternatives or 2 alternatives they want to consider, and we give them that number, and they make the decision, and their board make the decision before we start the monthly journal process. And that's really what we're doing now up to 1 July, making those decisions with them, with the knowledge of the data, and then from 1 July, we'll give it to them on a monthly basis. We can calculate the transition adjustment, where people say we're only focused on the transition adjustment at this stage. However, I would warn these clients about the limitations of just focusing on a transition adjustment and not considering the ongoing impact on profit and loss, because that can sway you to a different transition approach. And this is really a separate quote depending on what you want. And then sometimes for audit clients, we just do implementation advice or guidance, work with them with their existing technology solutions on what they want. So really, we are guided by our clients on what they want, what they need, because we want to help clients. That's why we're here. That's our job. I would like to hand back to Kevin to talk about some of the other practical implementation issues that we've encountered. At the moment, we focused on project management and process issues, which is by far the biggest issue, but we thought we'll just flag a few other practical implementation issues as well.
Thank you, Aletta. I've prepared really just one slide here, and these are probably the practical implementation issues that kind of drop out of the standard, where when you read the standard, they perhaps don't seem as obvious, but when you start to apply the standard, they emerge, because in reality, accounting systems produce information which doesn't neatly align with the world of the accounting standard. First thing is embedded leases. Most clients that are coming to us and saying, we would like you to help us with our software or our accounting, they'll tell us, oh, we have 200 property leases. When we start to work with them, we start to realize that embedded in other contracts are a multitude of other leases. In some cases, you have leases embedded in sales and customer contracts. And ultimately that number, which really is, let's say, 200 property leases, becomes 300 property leases, 5 motor vehicles, and a host of equipment leases which no one saw coming. What I actually like to say to a client is, walk around your office sites or your locations and look at everything in the organization that you don't own, that you're paying somebody else to service or to use. Even water coolers came up the other day because somebody had to come in and put water in the water coolers for the staff, and they were paying them a service fee for that. But the question is, are they leasing the water coolers? So that can be an issue. Now, not all of that actually gets captured by the new leasing standard, but when you actually start to get to this, you run into these issues really quickly, and you suddenly have hundreds of leases you didn't realize you had in the past because they're embedded in service contracts, sales contracts, or perhaps they just haven't been thought about. The other one is lease and non-lease components. This is something that really is interesting. I don't think any software solution can give you the answer to this. And actually, I think it's a whole project all by itself. The standard is very clear that lease payments or payments that are linked to the leasing of assets in some cases have to be broken up into lease and non-lease components. And I'm actually going to link this to the lessor accounting bullet point on the slide. This came up with a property lease company. This is the large listed company that's leasing specialist shopping centers and other stores in shopping centers to tenants. And the way the leases are structured are generally the same. You charge a monthly amount to lease the premises, but you also charge things like property taxes and their proportionate share of the shopping center costs, such as cleaning, security. Those components, such as security and cleaning, are actually the delivery of a service to those tenants, which means the amount of money that's earned by the lessor to provide those services is not actually captured by the leasing standard. It's captured by the revenue standard because the lessor is earning revenue by providing cleaning and security services. This requires you to break the lease into components, and some of the lease is captured under the revenue standard. That's IFRS 15, and the rest is accounted for under IFRS 16. So even for lessors, do not be captured and into thinking that there is very little change coming. I think we're actually very bad as an industry. We've given the impression that the lessors are scot-free under the new standard, that they don't really have much of an implication coming. But when you get down to it, the lease and non-lease components actually means that you've got this interaction between leasing standard and the revenue standard, and you actually have to break your lease payment or your lease income up into various components and account for it under different leasing standards. So there are problems arising in that area. The other one is fixed, variable, and in substance fixed payments. Aletta and I had a lot of fun with this. Actually, the entire IFRS team at BDO had a lot of fun with this at the end of last year, and I'm not even sure we've resolved all the questions under this one, Aletta. But I'll give you again an example that relates to the property leases. Very often the payments such as property taxes and insurance and security, all those payments that are made by a lessee to a lessor are only determined either at the end of the financial year because an estimate is made at the beginning of the year, which is provided or trued up at the end of the year. That means that the lease payment is variable, and then at some point it becomes fixed, or it might have been fixed all along. And depending on whether it's fixed, variable, or in substance, the accounting is different under every scenario. Some of them are taken into account at the start of the lease. Some of them are not taken into account at all and are expensed as they incurred. And here's the tricky one. Some of them have to be trued up into both the right of use asset and the lease liability on an annual basis. In other words, a change of estimate every year to the balance of your lease liability and the right of use asset. So that's another complication to think about. I think we've covered the business problem in terms of budgets and forecast. I think Aletta has made that clear. This is not just what's the number going to be each year. You do need to do this on a budget and forecasting basis. And a tricky one I ran into very recently is this concept of inception and commencement date. The time difference between signing a lease and starting to actually account for it when you occupy or take control of using the asset, if there are transactions between that period, they get accounted for very differently than if there are transactions after you've occupied it. And the best example of this again is when you have a property lease and perhaps there are lease incentives flowing, or perhaps you have to incur expenses on, let's say, leasehold improvements. If you are making improvements to the property before you take occupation, and if you are making those expenses after occupation, the accounting is different. So you need to be aware of that. And then last but not least, this is the poor child that gets left behind. No one ever thinks about the disclosures. And suddenly, 2 days before issuing your financials, you suddenly realize that there is a heap of disclosures that need to be made, and that hasn't actually been thought of. So those issues are things to be kept in mind. And if those didn't ring true to you, or if you didn't understand what I was talking about, feel free to give us a call or to bring the IFRS person in your organization into the discussion, because these are some of the practical issues that you start to run into when you actually start to get down to data collection, data assessment, and actually running the numbers. Questions directors should ask. We're into the final hurdle now. Aletta is going to bring online now questions that directors should ask. These were questions that were developed by Aletta. They're on the Institute of Company Directors website. Many of them are governance questions at the start, and then there are some wonderful questions that relate to individual standards, one of which is AASB 16 or IFRS 16. I think we've covered many of these. It's a good place to start. Because these are governance levels, they're probably the questions the boards and the audit committee should be asking, and they should be asking these of management and the project team that is running the project on these, just to make sure you've covered things. So that's something you can do in your own time. In terms of next steps, look, this is a repeat of some of the next steps we've had in previous slides. I think also we'll leave this for you to look at a later stage. Some of these steps are covered in the questions that were on the Institute of Company Directors site, so I'll let you go and look at that yourselves. But it's things like, do you have the data? Have you thought of your technology solution? How are you going to maintain the data? And notice that word risk assessment there. This is a business problem. So treat this as a risk assessment of IFRS 16. On the next slide, we have things like, have you identified or designed an appropriate response? There's the project plan question. And we've highlighted the technology solution question again. Funny enough, Aletta, I actually think we did this together a year ago, these questions. I think we've kind of just brought them across because we did a session last year on risk assessment, which Aletta, I think I'll let you cover now, because Aletta is going to give you a summary of all the resources we have already available to you on this topic. So if you need to refresh your knowledge, you can go back and have a look at that. So Aletta, back to you.
Thank you very much, Kevin. I think I just wanted to flag that, this project, we've been working on IFRS 16 for many years now, and there's a lot of information that you can use to help you. And we've talked about the need for IFRS knowledge, and if you're looking for that, where you can find it. The first thing I've got there is you're attending the webinar, so you would know that we've released our webinars for 2019, or the topics have been released for 2019. And I thought I'll just flag that you'll see that later on in the year, we've got a very specific session where we'll be looking at disclosures around IFRS 16. So we've spent a lot of time on all the other aspects, and if I can find it quickly, 19 June 2019, we're disclosing the impact of implementing IFRS 16. So this whole year, we're definitely focusing on practical issues around 9, 15, 16, and AASB 1058 for not-for-profits. And we also, in the second half of the year, look at disclosing all of these. The following is a list of all the webinars we've done over the last 2 years that's specifically related to IFRS 16. So over the last 2 years, we've done 24 webinars that's available on our website, as well as the PowerPoint slides. And here you can see 6 of the 24 were assigned to IFRS 16. We looked at a general overview. We looked at identifying a lease, determining lease term, embedded leases, recognition measurement. The September one's been very popular around transitioning to IFRS 16 and the different transitional approaches. October, we looked at risk assessment, and December again was a very popular one where we looked at technical problem areas, where today we looked at practical implementation issues, which is a slightly different flavor to it. If you look at other things, as you know, we do newsletters every month, and those newsletters also include short videos, and you can subscribe for those. On BDO Australia's LinkedIn site, we also release it, as well as Kevin and I would do that, and the IFRS advisory team. And we also have a number of technical publications that are actually issued by BDO Global. And these are amazing publications. And if you look at IFRS technical resources, particularly if you look at the IFRS in practice, you'll see the IFRS in practice. There's a number of documents around all these standards, but the IFRS 16 around leases has been updated in February last year. It's more than 100 pages with quite amazing examples for you to look at, and it's definitely highly recommended. And there you can see what it looks like, the IFRS in practice. Fantastic information. If you're looking for technical advice, Melbourne or national, you can contact me. In Perth, our colleague Wayne Basford, and we also have a new partner in Perth, Susan Oldmeadow Hall. Please feel free to contact her as well. In Sydney, you can contact Kevin, and in Brisbane, Clark Gerald. But in any ways, if you want to have contact details, there's a link for you as well, and we're happy to speak to you. This is the bigger team, and I'm looking at it this morning, and I realized that we've had another new member join us, Lynn, who's based in Adelaide, and I need to put her photo in there, and then it's all aligned. And we hoping to continue to grow. If you've got any further questions for Kevin and I, please feel free to put that in the question box, or to email us, or to phone us. You're more than welcome. It is 4 minutes before 12, so I want to say thank you very much for attending, and we'll speak again next month.
Thank you and goodbye.